You are welcome to another video. So here is a problem on single entry and incomplete records. Dami Enterprise, they don't keep proper book of accounts. So I'm employed to help them to correct all this. So you can see the cash book and additional information. The first thing we are to do is to prepare the statement of affairs, that is the opening statement of affairs. And don't forget, when you start writing up this, you are going to start with the name of the enterprise, which is Dami. So we have Dami Enterprise. Statement of affairs. Affairs as at 31st December 1998. So we are starting with our non-current asset. Non-current asset. And the currency is Naira, right? So the non-current assets, do you have any non-current assets? We have stock, we have debtor, we have creditor. So no current assets there. Then we'll move to no non-current assets. So we'll start with current assets. So we have stock, which is 1,200. Debtors, that is 1,220. What else? We have rates prepaid. Rates prepaid. So that is 160. And the rest here is current liabilities. Don't forget, from our cash book, we have balance brought forward and balance carried down. So the balance brought forward, we also move to the statement, opening statement of affairs. So we have cash in hand. It's trying to tell us the cash at the beginning, which is 2,000. So let's add this up. This gives us 805 and 4. So we have 4,580 as our current assets. So current liabilities. For the current liabilities, we are starting with creditors. Which is 300. Postage owing. That's 150. Then sundry expenses. Owing or accrued. So the postage owing is 300. The sundry expenses is 150. While the creditor, that's 780. So let's add this up. We have 0, 13 plus 1. 13 plus, that's 13. 13. So let me add it up again. 1,000, 2,000, 230. So it should be 1,230. And don't forget the balance here, we are going to less it from our current assets to get our capital at the beginning. So let's subtract this coming. This gives 350. So we have 3,350. 3,350 is the opening capital. This will be called the opening capital, our capital at the beginning. So don't forget, we are lessing it. And under, the equation is given by capital is equal to assets minus liabilities. So the next thing now is that we want to prepare a statement of profit and loss. So one thing you should note from this question is that we are giving information on how to get our sales and purchase. So we are not going to be doing the computation of how will I say it, opening capital, closing capital, then we subtract it to get our net profit. But here we are going to prepare a normal trading profit and loss account, that is statement of profit and loss and other comprehensive income, because we have given the some information on our debtors and creditors, which we can use to get our sales and purchase. So the next step is to prepare a control account. We are preparing a control account. The first one is going to be debtors control account. So for the debtors control account, we use this to get our sales. Now, what's the balance of the debtor at the beginning? So at the beginning, this is the balance for debtors. Those are owing us. That's 1,220. During the year, some debtors pay. So they pay their balance, and that is 36,000. So the cash we receive during the year, we need to subtract it from the balance, right? 36,000 naira. And at the end, those that are still owing you is 1,110. So at the end of this transaction, those that are owing us balance brought down. That is 1,110. And don't forget, when you have balance brought down here, it simply means that the balance carried down here is also, sorry, balance carried down 1,110. And when you add this up, we have 37,110. Here also 37,110. And don't forget, your balance brought forward plus your credit sales here is going to give you the total balance here also. It's going to give us this total balance. So we are going to write our sales. And to get that, it simply means that 37,110 naira minus 1,220 naira. So that is 35,890. 35,890. That's for the sales. Now for the purchase, we are going to prepare creditors control account. Creditors, sorry, should be debit credit, not the naira, sir. Creditors control account. So, and we know that the creditors has a credit balance. Our balance brought forward will be the balance of the creditors at the beginning is 780. So at the end, the balance of the creditors, the balance of the creditors at the end, that is 812 naira. It simply means that we have a balance carried down here, which is 812. Also, we paid some cash to our suppliers. So, in respect to the money we are owing him or her. So the cash we paid during the year was 24,000. 24,000. So the total simply means 24. We simply give 24,812. 24,812. So 24,812 minus 780. The difference here is the purchase, that is credit purchase, 24,032. So I've gotten our purchase that is 24,032. Our sales, that is 35,890. Then our capital at the beginning, That is 3,350. Now we are moving to the statement of profit and loss. Statement of profit loss and other comprehensive income for the year ended. So the year is that's 31st December 1999. We are starting with the sales. The sales. So we are using the vertical method. We are not using the normal method, that is the T format. The sales, don't forget we calculated the sales and the balance is 35,890. Then we will need to determine our cost of goods sold. Cost of goods sold. To determine our cost of goods sold, we are starting with our opening stock. Our opening stock that is 1,200. Then add purchases. So the purchase you got, which is 24,032 naira. Is that carried inward or return inward? We don't have that. What else? So let's add this up first. We have 232, then 25. So 25,232. Then we are going to less the closing stock. The closing stock, which is 700 now. When we less this, we are going to get 24,532. So this is our cost of goods sold, 24,532. Then we subtract that from our sales to get the gross profit. I'm coming. Minus 35,890, which is 11,358. This is our gross profit. So we are going to look at the additional information. Okay, from our cash book, we have some expenses and we have income also. So for the income part, we start with rent received. Rent received. So for the rent received, we have 1,450 to be added to the gross profit. Then we have expenses. For the expenses, let's start with salaries. For the salaries, do you have any additional information? No additional information. So the salaries is 1,000 naira. That is 150. No? Now, there's an adjustment for the Sunday expenses. We have the cash during the year, right? Is 150. Then we have sundry expenses accrued at the beginning 150 and at the end 130. So how do we compute this? Don't forget, sundry expenses at the beginning, it is representing the previous year only, right? The sundry expenses that you should have paid for the previous year, that is the sundry expenses at the beginning. So it simply means that we will need to subtract it from the cash. We will need to subtract the previous year, I think it's for last year, it's not for this year. So you subtract it from the cash, which simply means that sundry expenses at the beginning, 150 will be subtracted. Then at the end, sundry expenses at the end, that is 31st December 1999, is representing the expenses for this current year. So it's going to be added. Now, when you compute this cancel out each other, we have 130. So the sundry expenses that is going to our profit and loss account is 130. Then the next one is the general expenses. The general expenses. So there's no additional information there. So we have 1750, 1750. Drawings is going to the balance sheet. We have rate. So the rate in the cash book, that is 2000. But when you look at the additional information, rate prepaid at the beginning and we have rate prepaid at the end. So rate prepaid at the beginning is 160, rate prepaid at the end is 150. So at the beginning now, when rate is prepaid at the beginning, it's not for that year, it's not for the previous year, but it's for the next year, which is the current year. Yeah. Do you understand the logic now? Rate prepaid at the beginning simply means that the rate was prepaid at the end of last year. So when the rate was prepared at the end of the last year, it's for this current year. It simply means that we are going to add rate prepaid at the beginning to it because it's for this current year. But rate prepaid at the end is not for that year, it's for the next year. You know that prepaid simply means you are paying in advance. It's not for that year, it's for the next year. So rate prepaid at the end is for the next year, it's not for this year that we are working for. So we need to subtract it from it. Minus 150. Then our balance is going to be 2010. The next one we have postage. Postage. For postage, the balance in our cash book is 1425. Then we have postage owing and oh yes, postage owing at the beginning and at the end. For postage owing, so at the beginning we have 300, at the end we have 200. So same way we treated sundry accrued expenses accrued, that's how we are going to treat postage owing because they mean the same thing. So at the beginning you are subtracting at the beginning because it's not for the current year, it's for the previous year. We have minus 300. Then at the end is for that year, that is 200 plus 200. Wait now. So we are going to have minus 100, 1325. And we'll add this up. 1000 plus, sorry, 1000 plus 110 was 1750 plus 2010 plus 1325. So that is 6215 naira. So let's add this up. We are going to have 12,000, then 12,808. So 12,808 minus 6,215. That is 6,593. So this is our net profit for the year. Net profit for the year is 6,000. Net profit, which is 6,593. So the last part there is to prepare the statement of financial position. So for the statement of financial position, let's write that out for statement of financial position as at 31st December 1999. We don't have any fixed assets, right? No current asset. We don't have any non-current asset. So we'll start with, you can just write our assets. Our assets, it comprises of non-current asset and current assets. The first one is cash. So we have cash in hand. So the cash in hand in your financial position is talking about the balance of the cash you have in the cash book. So the balance there is 15,125 naira. After that, we have stock. For the stock, that is 700 naira. Stock at the end. So it's the closing stock that we're looking at. We have debtor. There's no adjustment for debtor. So for adjustment of debtor, we'll be giving debt. We'll be asked to write off some debt, but we don't have that in our question. So we just write the balance at the end, which is 1,110. Also, do you have any other current asset? First one, second one. Then we have rate prepaid. Rate prepaid, which is 150. So why rate prepaid is a current asset is that it's an expenses but you have paid in advance. So you can ask for it back. It's an asset in your own perspective. Now the next one is to look for our liabilities. So we have current liabilities. For the current liabilities, we start with the creditors. The balance of the creditor at the end, which is 812, we'll add this up, less current liabilities. Then postage owing. Postage owing, that's 200 naira. Sundry expenses owing. For the sundry expenses, that is 130. And what else do we have? Nothing. So we add this up. So the addition of all this is going to give us 10, 11, 1,400 and 1,124, 142 rather. So let's add this up also. We have 5, 8, 10, 10, 6, 7, and 1. So that's 17,085 naira. And here we have 1,142. But we are going to less this. So let's let it now. 17,085 naira minus 1,142. So that gives 15,943. Now let's look at the amount we used to finance this. Financed by, starting with the capital. So the opening capital when we started this was 3,350 naira. But we have an additional capital. So you can see that from the given information, additional capital of 10,000 naira. Instead of writing this, let's just join the two together. Let's merge it together. So it will just be 10,000 naira, which is the additional capital, plus 3,350. 3,350 is gotten by from the statement of affairs, opening statement of affairs. So this is 13,350. Now we are going to add our profit to it, net profit. The net profit, which is 6,593. So let's look at the balance there. The balance there is going to be, we have 3, we have 4, there's 9, 1. So 19,943. Then less drawings. So the proprietor withdraw some goods which worth 4,000 naira. We are going to less that 4,000 naira. So when you less this, we are going to get 15,943. So you can see that after subtracting our current liability from the current assets, the balance is equal to that of the amount we used to finance it. So I've come to the end of the video. Thank you for watching. Please don't forget to like, share, and subscribe to my channel. Bye.